profits, or if you have any money on you, where do you invest it? So we are giving you different options, and among them today is unit trusts as a form of investment in our country. So in our discussion today, we have a panel of two gentlemen and a lady, Gladys Kavuma, who is going to be the moderator for the session. Allow me welcome Gladys and say more about her. So Gladys has over 13 years experience in the financial services industry across strategy, treasury, digital transformation, business development, and project functions. She has worked with local and regional financial institutions across Africa and has led teams in Uganda, Kenya, and Tanzania. In her current role as a Chief Operating Officer at Zeno Investment Management, Gladys spearheads growth and partnerships. Gladys holds a Bachelor's of Economics and Finance degree from University of Cape Town. Gladys, you're most welcome to our session. Gladys is going to be the moderator today. But before we start the session, allow us put out our poll so that we can be able to understand the audience. So please kindly respond to our poll that is running on our Zoom account so that we can get to understand the kind of audience we are discussing with this morning. Okay, thank you so much. So we shall give it about 1 second, then we shall be able to get the results. So please kindly end the poll so that we can get to understand the kind of audience we are discussing with today. Okay, I need to see the results. Thank you. So today our audience we don't have anyone below 20 years.
To be here to run this session, to have this session on unit trusts. I'd like to introduce the two panelists. I'll start with the gentleman at the extreme left, Mr. John Tende, aka the Money Engineer. John is a finance professional with an engineering background. He has over 13 years practical experience in business strategy, finance, management, and investment. He currently leads the corporate strategy team at the Electricity Regulatory Authority. John is passionate about helping people realize their true potential through personal development and financial literacy. He's also an avid entrepreneur and runs a small manufacturing facility which makes food condiments and fruit juices. He publishes a daily online blog to teach and inspire other people to take charge of their money. In his free time, he grows fish in his backyard. John is also a published author, having written 2 books on backyard fish farming and financial literacy. John is married with 2 children and currently lives and works in Uganda. Welcome, John.
Thank you, Gladys.
And our second panelist, who I believe will carry the day for us today, really, because he is from the regulator, the Capital Markets Authority. Please welcome Dixon Sembuya, who is the Director Market Development at the Capital Markets Authority. He is charged with investor protection. So Dixon has a BCom accounting and an MBA finance, and he passed his CFA level 3. Welcome, Dixon. We look forward to engaging with you this morning.
Thank you.
All right, as we kick off, there's that word that's been thrown around a lot, especially as people think about what can they invest in. For financial markets, it is known that the Ugandan market is still developing, and for most people, they only hear about unit trusts when they are approached. Very few people go out looking specifically for unit trusts. Dixon, I'd like you to shed a bit more light. What is a unit trust? How does it fit into the Ugandan financial markets?
Thank you very much. Now, when we talk about a unit trust is simply an investment product where you and my colleague here, we pool our resources together. So we pool all our resources into this investment vehicle, and once we pool our resources, we hand over our resources to a professional manager. Okay, so this is someone who's licensed, someone who's qualified to manage money, and so this particular professional manager will make all the investment decisions on our behalf. Okay, so it comes with so many benefits. You've handed your money to a professional, so this is someone who studied markets. This is someone who understands how markets function. This is someone who can buy, save, buy securities and sell securities for and on your behalf based on macroeconomic conditions, based on company fundamentals, you name it. So it's that pool, okay, that pool where me, I, you, we pool together resources, and of course there's always a lot of advantages that come with the pooling. You're dealing with a larger pool, you're dealing with larger numbers, and of course you have economies of scales, where it gets more affordable to invest, the costs come down, you're likely to have more diversity, you name it. Now, where exactly does this particular product fit within the investing landscape? One, the Capital Markets Authority, which is the regulator for the industry. Allow me to introduce the regulator. The Capital Markets Authority has been at the forefront of pushing for investments through collective investment schemes. Okay. Now, we are very much alive to the fact that the level of sophistication in as far as Ugandan investors is concerned is not so high. Okay, so you'd rather actually have Ugandans invest through pooled vehicles that are professionally managed. Okay, so there's that particular advantage, or there's that particular push factor, a pooled investment that is professionally managed. Additionally, if you look at pooled investment vehicles, I think I've alluded to scale. Okay, you have a much larger scale. Okay, so that essentially means that once we've pooled a lot of resources, it essentially means that we're able to invest in a lot more products. We can invest in much more securities that I myself as an individual might not be able to invest in. Now, putting on my regulatory hat, I think one of the most important aspects in as far as regulating is concerned, apart from creating order, I think everything is done with investor protection in mind or at heart. So if you look at how collective investment schemes are structured, they're actually structured with investor protection in mind. So we can break down the different parties involved in a standard collective investment scheme arrangement. So you have you, the investor, who has a bit of savings. Then you have what is called a custodian. Okay, so the custodian is usually a bank. Okay, so this custodian will receive your funds. This custodian will also hold your assets, will provide custody over your assets. Then we also have what are called trustees, and the role of the trustees. Trustees hold assets for the benefits of the investors. So they are the legal owners, but for the benefit of the actual contributors. And I normally like looking at trustees as a board, a policy organ, okay, a decision-making organ, okay, but with a fiduciary duty. They have a very high bar in as far as their fiduciary duties are concerned, okay. Then of course you have the operator or the manager, okay, and that is where you have players such as Zeno, okay, who are usually the front-facing the front-facing entities that an average investor will get to interact with. Okay, so they'll take my order, they'll place my order, issue instructions to the custodian, they will provide a statement, they'll receive my redemption form if at all I want to exit, you name it. So the whole idea behind having all these parties within the structure is risk management. You want to manage risk. You want to spread out the risk among so many parties, and this translates into enhanced investor protection. Yeah, so I hope in a nutshell I've been able to summarize. I know at times I can use so many words, but I hope I've done some justice.
So let me try summarize. Thank you so much, Dixon, for that. So to replay, we have the regulator. The regulator sets out how the collective investment schemes should be run in the financial markets in Uganda, and that's the Capital Markets Authority. And then the investor, those are the people, the investor who then contributes their funds into the unit trust, will have a relationship with a custodian, a trustee, and the fund manager, right? So the custodian is usually the bank, and that the custodian holds the assets in protection. The trustee is like the policy owner, provides the statements, sort of the police for the fund manager, for the professional fund manager. And then we have the fund managers who actually make the investment decisions and manage the funds that are collected. So currently in Uganda, I do know that we have 6 licensed fund managers. Could you speak about the licensing process just for a bit? Because investors do need to know what process companies go through to actually be licensed to manage unit trusts in Uganda.
Okay, now collective investment schemes generally in Uganda are regulated under the CIS Act, or Collective Investment Scheme Act of 2003, which basically provides details on their creation, provides details on the operations, you name it. Then usually the act provides very broad principles, which are explained further through regulations. So there are quite a number of regulations pertaining to collective investment schemes, and they specifically a licensing regulation for collective investment schemes. Now there are quite a number of requirements. For you to be an operator, from being an incorporated company, there are also capital requirements, resource requirements. We also look at who your personnel are, or who your staff are. Are they fit and proper individuals? Do they have the necessary qualifications? We also look at your business plans. How do you intend to grow the market? The beauty about these regulations is uniformity. I think they ensure that whoever comes into the market meets a certain minimum, requirements or minimum competencies, which again ensures that investors' savings will be safeguarded or protected, because whoever we're letting in, because licensing is all about pre-admission. Okay, who are you letting in? So before you let them in, you get a chance to vet them. You get a chance to do a bit of due diligence. Okay, so before we let you in through licensing, there's a lot of due diligence that's undertaken. Investigations here and there, who you are, who your directors are, who your management is, how qualified are your staff, do you have the necessary financial resources, do you have the experience, do you have the technical know-how to be able to manage or run a CIS fund, Are you a person of integrity, or are those going to work for you people of integrity? So that ensures that, certain minimum requirements are met, and which should eventually translate into enhanced protection for your savings as an investor.
All right, thank you. And Dixon, as I said, you're carrying the day for us, coming from the regulator. So just a few more questions for you before I move on to John. So for most people, they do not, unit trust, when we hear collective investment schemes, what is the underlying asset? Where does the unit trust get its value from? That's a key question that we keep hearing. Would you please shed some light on that?
Now, for all intents and purposes, I usually like looking at a unit trust as some form of derived product, okay, because its value tracks an underlying product. So what happens is that a manager, a licensed manager, for them to collect funds from you, they set up specific funds, and these funds have got different strategies. I'll give an example of what is called a money market fund. Now, a money market fund will have the strategy of investing in short-term instruments, okay, interest-bearing instruments, okay, instruments that should ideally have a term of 12 months or less, or you could have a scenario where the whole portfolio has a duration of, or a term of less than 12 months. So that's a strategy where this particular manager will invest your savings in instruments that are interest bearing and have a term of less than 12 months. Okay, so the unit that you're given, okay, represents your proportionate ownership of the underlying securities, which could be treasury bills. I could also decide to do commercial papers. I could also decide to do fixed deposits. So this unit that I'm given represents that proportional ownership of whatever treasury bills are underlying whatever amounts have been deposited in a fixed deposit account. Okay, so your unit represents proportionate ownership of these securities that are in this fund. Okay, so the different strategies, like I said, a money market fund is just one of them. You can have an equity fund which will invest exclusively in listed shares or listed equities. You can also have a balanced fund which could have fixed income securities as well as shares, depending on the manager's strategy. And again, at the end of the day, you as an investor should be alive to what your goals are as a person. Okay, you should be alive to your goals, and your goals should lead you to invest in a given strategy. Okay, are you trying to save up for are you trying to save fees for your son who's going to university in the next 2 years? Okay, so based on that goal, then I should be able to work with my advisor to appropriately guide me into a fund that will be able to meet that specific goal that I have as an individual. Yeah. So I guess as I conclude, or as a wrap up, one, it's very important for you to, this is a message I normally echo whenever I get the platform, so you'll allow me to re-echo this further. It's very important for Ugandans to deal with only licensed entities. Okay, and as a regulator, we do publish a list of entities that we have licensed to provide different services within the capital market space. So it's very important that before you commit your funds anywhere, okay, you actually confirm whether the entity you're dealing with has some sort of legal recognition. Okay, so it's important for Ugandans to ensure that they only deal with regulated entities. Yeah, and the other thing that I also emphasize is linking your goals to your investments. I think ultimately your goals should always guide or should provide direction in as far as the appropriate investment is concerned. So Ugandans need to have their goals are very clear, okay, as they go about the process of investing. So everything should be derived from a goal as you go about the business of investing.
All right, awesome. Thank you so much for that insightful information. And one last question for you before I move on to John. What is the current size of unit trusts in Uganda? Where do you see the future of Ugandan unit trusts compared to what's happening, say, in the region? Thank you.
Okay. Currently, CIS managers have been able to mobilize slightly over 1 trillion Uganda shillings. Okay, now this is in a period of about 4 years. So we basically started a subsector from a scratch almost 4 or 5 years ago. And in that period of 4 or 5 years, the subsector has been able to mobilize slightly above 1 trillion in savings from Ugandans. And I must admit, 4 or 5 years ago, you know, the question I was being asked was, you know, are we trying to push something that doesn't have legs? Will this grow? Will this take off? But we kept the faith. We've worked very closely with, you know, the different players, and you know, the market has actually grown to the surprise of so many of us. You know, we'd made projections, but our projections were very conservative. We didn't see this coming, but it's actually happened. So where do I see the CIS sector or subsector in the next 3 or 4 years? We expect that in the next, at the current pace of growth, we expect that we should be able to hit about 2.5 trillion in assets under management in the next 3 to 4 years. Again, which points to, you know, the resilience of the sector, which points to the tenacity of you know, the different players within the sector. But we expect that growth of about growth to AUM of about 2.5 trillion in the next you know, 3 to 4 years. Within the region, currently within the region, assets under management stand at about 1.2 billion US dollars, which again you know, points to the increasing popularity of CISs or collective investment schemes as an alternative that Ugandans or other people within the region can tap into, you know, and you know, save their money through. Okay, so this is a growing area. It's rapidly growing, and there's a lot of support, you know, from the regulator. There's a lot of support from the Ministry of Finance, you know, in trying to push this sector, in trying to grow this sector. Yeah.
All right, thank you so much, Dixon. John, the money engineer.
Yes, thank you, Gladys.
I've been waiting to ask you, do you have any investments in unit trusts, and how did you make that decision to invest in unit trusts?
Yes, thank you, Gladys. Actually hold a number of investments. Practically all of them. I like experimenting with the different possible vehicles. And I learned of unit trusts sometime in 2018. I think one of the companies, they sent an agent to our place of work. And so the guy was moving around our offices, and they came to my office. So I started inquiring about what this whole unit trust business is all about. I wish CML could come up with a better name, which is easier for Ugandans. But yeah, so I just experimented because one, they told me all I needed to invest was 100,000. I immediately said, "Are you sure?" So immediately I signed up the forms. The process was so easy, seamless. And why I like unit trust is it's one of the easiest investments you can do, at least from my perspective. For as little as 100,000, you can tell your friends in the bar that you're an investor. So I particularly like unit trusts. So before you run around with chicken and goats, I think unit trust is one of the easiest things you can do to start earning some passive income. So one, it's fairly easy to sign up. The investment requirement is so low, so that's what attracted me to them. And I've seen the market grow with new players coming on board. I can operate from my office. I can invest using an app. I can sign up funds. When I want to withdraw money, I just send an email and I get the funds, and I get a fair return. It's not the highest return in the world, but it's quite fair. And I think the regulations are working, because I held some unit trusts in Stanlib, and when Stanlib was exiting and moving over the funds to ICEA, I remember that process was quite seamless. And so I saw that it's fairly the risk is a bit low compared to other asset classes. It's a very passive form of investment. The requirement is low. The investment requirement is quite low. And it's a way to have liquid cash. So I know school fees season is coming up. Some people are going to act surprised next week. But for those of us who have unit trusts, it's a matter of sending an email to our fund manager and we shall get some money. So I think that's what drew me to unit trusts. And I appreciate the Capital Markets Authority and all the players, all the education they're doing to really encourage Ugandans to save and invest. Thank you, Gladys.
All right, thanks, John. I'm impressed that you actually know what to use the unit trust for, particularly on the liquidity, because that's something that very many investors are concerned about. How quickly can they access their money? What's the process to get it back? And I know that there's also been a concern around the returns, and you've mentioned it as well. How do you make peace with what you've been earning off the unit trusts?
Thank you, Gladys. So in terms of the return, the interest rate, I would say, is fair, averaging anywhere between 9 and 12% per year. I know some people argue that, but that seems so little. But then my argument is that for doing nothing, it's quite a lot. Because if you try to do that running a small shop, and I know many of you here run small businesses, you will see that it's actually quite difficult to make such a return for very little effort. So for me, compared to the risk you're taking and the level of engagement, I think it's a fair return. And I know the moderators will speak to that in a minute. In terms of getting my money, from my experience, at least for the players I work with, most times I get my money same day, as long as I send in my redemption form before 10 in the morning. Same day I get the money. Worst case is usually 48 hours. 48 hours I have the money. I've not had any instance where I've failed to withdraw my funds. So I think that, just to assure the people out there, it's one of the safest investments. And like Dixon said, you have to work with the licensed players. And I know you will mention them in a short while. It's not a Ponzi scheme. Someone was asking me, is this a Ponzi scheme? No, it's not a pyramid scheme. This is a licensed investment vehicle. If you go to the CMA website, there's a lot of data and information for all aspiring investors. Thank you.
All right, please, Dixon, pitch in.
Just to add on something, in as far as returns are concerned, I'm actually an investor myself in unit trusts, and I've been investing for so many years. And maybe just to comment on the return question, what I can say is that there's always a trade-off between risk and return. So if you want very, very high returns, then you also need to engage in a very risky investment. Okay, now this is not the case with the unit trusts. These are not very risky investments, so the return will not be so high. But one other thing that I keep on telling people is that I have to look at unit trusts as part of my diversification strategy. Okay, so I'll run my small shop. I'll have my farming project, okay, which is exposed to a lot of uncertainty, global warming, climate change. Okay, I'll run my small shop. I mean, run a small taxi, exposed to all manner of risks. Okay, but as part of diversification, I also hold a bit of financial assets. Okay, and the unit trusts are part of those financial assets that I would prefer to hold as part of my entire portfolio or my investments. Okay, so I'd look at it from that perspective of you need to diversify. Yes, there could be other very high risk, high return investment options, but I think it's very important for you to also diversify. You need to spread yourself out, be in low risk investments as well as high risk investments. That's how I'd like to look at it. And I think ultimately, you're in low risk, you're in high risk. I think that should even moderate the risk or wait it out. Yeah.
Right. Thank you, Dixon. You actually touched on a very important point, which is diversification. And in the financial market world, there was a quote by an economist, and he said diversification is the only free lunch. And as investors out there, you can't put all your eggs in one basket. And I think that unit trusts is one way of diversifying your investment portfolio. John, would you speak a bit more about diversification? I know you're an entrepreneur, you have a corporate job, you're doing unit trusts. When you're tackling financial literacy and diversification, how do you encourage other investors to tackle that? Thank you.
Thank you, Gladys. I think this issue of diversification became quite apparent during the COVID pandemic. I think many of us can attest were affected. We had a small business who was selling ketchup in schools. When COVID came, that business line just died. So you can imagine all the little savings we had pushed into this business. Now at the time we were developing another product, a juice, which helped us to move in the trading centers because those were not under lockdown. So Ugandans love land and physical things. I think it became quite apparent during COVID that the land could not feed, could not provide money to run your household. So the way I look at unit trusts is that they give you that diversification in terms of you have some liquidity. So once you have that liquidity, it can then help you either from the returns or from even drawing the principal to meet your day-to-day needs, be it in business or be it at an individual level. So, for instance, if you have an emergency fund, which many Ugandans don't, which emergency fund is recommended to be about 6 months or so of your expenses, then you hold such a thing, for instance, in your unit trust. And that money is available for day-to-day problems. So your car could break down. You could draw money from that fund. But also from a diversification point. So if you have a business and everything is in the business, what happens if that business collapsed? We saw schools struggling. So what Dixon said was very true. You need to have multiple streams of income. And I think the unit trust is one of the easiest things to do. You don't need a lot of money. We're not saying you to put hundreds, but of course you can put hundreds because you'll get a fair return for your level of risk. So it's one of the easiest way to diversify your portfolio. And even if you are employed, you have no time to run around and do other things. Having some money in a unit trust helps you to provide some insurance against the potential job loss. So if the company disappeared, you're not out on the street. At least you have some liquidity which buffers you in the event of anything.
Thank you, John. There's a Swahili proverb about haba na haba ujaza kibaba. So little by little, you will fill, you'll keep filling the jar or you'll fill the pot. And I'm not quite sure about the Uganda version. Do we have one? I hope so. I really hope so. Because I look at being able to set aside a small amount. It doesn't even have to be a little. It doesn't have to be a lot. Just the consistency of putting something aside over a certain period, it does add up it does add up. And I think that's part of the reason that the work that you're doing and the work that CMA is doing in terms of financial literacy and NSSF as well, it's very important to get people to understand that you don't have to wait till you have a lot of money, or you don't have to wait till you're too old or too young. You're never too old or never too young to start saving and investing. So I'd like to take a few questions at the moment from the audience. And I think the first question I'll direct it to Dixon. So I think, Dixon, this will be a very interesting one for you. Can my investment group of 10 members saving 50,000 per month open an account with CMA? Our savings are to help us, but at the same time, we want to grow our money. Please advise. Thanks.
Now, coincidentally, on Saturday, I was part of a group that was presenting to an investment club which is based in Marara on investing through unit trusts. Okay, so the idea was, to convince them to put a bit of member savings in unit trusts in addition to, so many other projects that they're currently running. They have money lending, they have a small shop, I think they have land, so we're just trying to convince them to do so. I'm also part of about 2 investment clubs. One of them is T United. T United has invested slightly over 200 million or so in unit trusts. Okay, and this is part of our diversification strategy in addition to so many other things that we're currently running. So this is a passive investment, very liquid. You're guaranteed of a modest return. I mean, I can even share the figure. On average, we get about 1% on our investments. So there are those comforts, there are those guarantees that saving and investing through unit trusts brings. And so my quick response to that would be, please just approach any of the licensed CIS managers, and your investment club will actually get your investment club will be able to get a CIS account, and you should be able to save part of your contributions through a CIS account.
So just to be clear for this question, I think the person is under the impression that they can open an account with CMA.
Okay. Now, CMA is a regulator, and I usually use the Bank of Uganda analogy to bring out what a regulator does. I'll take the case of Bank of Uganda. Bank of Uganda is the regulator for the banking sector. And so what Bank of Uganda does is that Bank of Uganda will license banks, commercial banks, microfinance institutions. Then Bank of Uganda will ensure that those who are licensed or admitted within the sector comply with the different legal requirements. From the Financial Institutions Act and any other resultant regulations. So Bank of Uganda will undertake surveillance. Bank of Uganda will undertake education to sensitize the public on banking. Bank of Uganda will inspect the commercial banks, or those who are licensed, to ensure that there's compliance with the regulatory framework. So that's the role of a regulator. So CMA is in the same space, but in this case in the capital markets sector. So CMA will license different players such as CS managers. CMA will undertake monitoring. CMA will undertake surveillance, inspections to ensure that there's compliance by those we license with the main or ultimate objective of protecting the investors. So CMA is the regulator, and for you to be able to invest, you need to approach those that we license, and in this case we have CS managers. Now if you go to the CMA website, there's a whole list of those we license, and among them are the CS managers. So you can approach any of these CS managers in order to invest your savings. I think they'll guide you appropriately, and you should be able to invest part of your contributions into collective investment schemes.
All right, thank you. So for those who are wondering, the licensed fund managers, currently 6 of them, ICEA, Britam, Sanlam, UAP, Zeno Investment, and Gen Africa. Those are the licensed fund managers, and you could approach any of them to actually purchase and participate in unit trusts. So this leads to the next question, which is what are the minimum requirements for one to invest in the unit trusts? Also, are treasury bonds and treasury bills part of unit trust funds? I'll hand that over to you, Dixon.
Okay, now minimum requirements, I think you just need to have your legal documentation so that you're able to open an account, and in this case I'm talking about an identity card. And in most cases, majority of the managers, for you to start investing, you only need about 100,000. Okay, so I believe that's an affordable entry point. It's an entry point that anyone keen on investing passively and earning a decent return in a safe environment can consider. Now, are treasury bills part of the underlying investments? Yes, absolutely. Specifically for managers who run what are called money market funds, which have an objective of investing in short-term interest-bearing instruments to earn a return for the investors. So part of what they invest in for you to get a return is treasury bills. Yes, so treasury bills can form part of the constituents of a given portfolio, or part of the constituents for a money market fund. Yeah.
Thank you, Dixon. I've got a question here from Charles Kalinzi. Where does the issue of trust and decision making leave the contributor? And how does the fund manager relay decisions to the poolers? John, I would like to draw on your experience so far with unit trusts. How have the issue of trust and decision making, how do you as a contributor to the unit trust, how do you deal with that?
Okay, I think like Dixon mentioned, this is a passive investment scheme. So as an investor, I delegate all the investment decisions to the fund manager. So I trust that this fund manager is going to act in my interest and also according to the rules of CMA to invest my money vis-a-vis the objective of the fund I've put my money in. So once I send my 100,000, there's nothing I do about it. So I just wait for my return at the end of the month, and I see my statement. I see how much they've made in the month and how much has been allocated to my particular account. And what was explained earlier is that there's a governance structure around these funds. So you have a custodian, who is typically a bank, and then you have the fund manager, who is the professional manager of the vehicle, and then you have the trustee, who is like a board. So it's really based on the trust. As an individual investor, my only point of control is to identify my goals and then to choose the vehicle and also the frequency and the amount of saving. Thank you.
Thank you, John. I believe, Dixon, you do have a contribution?
Yeah, maybe just to add on, the regulator has a role to play in as far as fostering that environment of trust is concerned. And one of the key ways that this is done is through the licensing. Okay, that entry bit, I mean, before admission, pre-admission, I think the regulator has a role to ensure that only those people who meet a given threshold in as far as probity is concerned are actually allowed to operate in the market. Okay, so that licensing, that pre-admission, that vetting that happens before you get into the market is actually very important in ensuring that only those who have certain resources, only those who have certain qualifications, only those who meet certain thresholds in as far as integrity is concerned are actually allowed to operate in the market. Then once you're admitted in, Okay, so now this is pre-admission. I mean, there are continuous inspections. There is continuous surveillance to ensure that you play by the rules, you conform to the requirements of your scheme documents, you conform to the requirements of the trust deed that establishes your fund. Okay, so there's that continuous engagement with all these players to ensure that they're in compliance with all the different documents, scheme documents, the trust deed, you name it. So that, I think, provides an additional layer of protection in ensuring that this relationship based on trust is actually sustained.
All right, thank you, Dixon. John, I've got a couple of questions for you from the investment angle. Charles Kalinzi would like to know a simple case scenario. Do you keep depositing 100,000 every month? How have you used your unit trust?
Thank you. Initially, when I started, of course, I was a bit skeptical. I didn't know what these things were. So I started with 100,000 just to test per month. And I made sure what has worked for me, by the way, is to try and automate the process. So what I've done with that 100K, then I instructed my bank every month to deduct that money and then invest it, send it direct to the fund manager. So when that happens, you kind of remove that emotion around saving money. So when I realized that it actually works, I then increased it depending on my goals. It's now much more than 100,000. I fear to say the number. Some people may think it's too much. Others will say it's too laughable. So, yeah, but the point is that what the literature suggests is that you need to be saving about 10 to 20%. So if as a young man or lady, a beginner, I saw some people in that 25, 30 year age range. If you started from your first job, and I wish I knew this much earlier, I should have started much long ago. But some of these vehicles were not available when we started working. So the point is you set an amount, a minimum of 100, as much as 20% or 10%. Then you try to automate it every month. If you have a regular job, you automate it. And after a few years, you'll actually be shocked by the amount of money you have. You will be literally shocked. So I think that's an easy approach people can take. Thank you.
Fantastic. Thank you, John. I would like to call on Dixon now. We do have to tackle the risk management and the risk questions. So I've gotten a couple from the audience that I think I'll just tackle one by one. I'll ask you one by one. How secure is your fund in case of your death? The investment in unit trust. That's one question. Should I read them all out, or would you want to take it one by one? Okay, so how secure is your fund in case of your death? Then what happens if all of a sudden the fund managers close? The fund manager closes. Is there insurance for the investor? And the other is there a risk when a government can intervene and start limiting the amount of money to be invested? Let's start with those three. So the first is about death. What happens when you die? And the second is on the closure of a fund manager, and the third is government intervention. Thank you.
You'll allow me to tackle the easier one first. I think that will help me build momentum to tackle the tougher ones. Now, what happens when a fund manager collapses? We've been very lucky since capital markets were established in Uganda in 1996. We've actually not witnessed the collapse of a fund manager. But in the event that a fund manager collapses, one of the things I would like to make very clear is that the fund manager does not hold your investments or assets. Okay, your assets are actually held by a custodian. Okay, so there is a custodian. In most cases, custodians are banks. So your assets are actually held for and on your behalf by a custodian. Okay, then you also have the trustees. Okay, who are actually the legal owners of those assets, but they're legal owners for the benefit of the contributors. Okay, so that has to be clear. Okay, that this is an arrangement where yes, someone has legal ownership, but there's a beneficial owner who is usually the contributor. Okay, so there's this segregation of roles. Okay, you have all these roles. Okay, and I think the whole idea behind this segregation of roles is exactly risk management. You're trying to manage risk. You're trying to avoid a scenario where you have one party basically controlling all the operations. Okay, so should a fund manager collapse, I think your assets are held separately from the fund manager, okay, or the CIS manager. Okay, the assets are actually held by the custodian. Okay, so what needs to happen is that during the process of, I think technically they call it resolution. Okay, during the process of resolution, your assets, your investments, which are held by a fund, which are held by a custodian, can actually just be transferred to the management of another CIS operator. Okay, so this manager does not hold your assets. This manager does not own your assets. There's clear segregation. Okay, and that segregation will aid in cutting down the risk. Now, there was a question of death. I think in as far as the question of death is concerned, I think I would defer to the succession laws of Uganda. Okay, I think I would just defer to the succession laws, which are very clear. You know, you need to get letters of administration, and once the letters of administration are available, then you know your CS account becomes or is considered to be part of your estate. So I think it now falls on your you know, administrators, you know, to work out how, you know, this will either be divided, how your CS holdings will be divided among your beneficiaries. So I think in this case there's nothing extraordinary about the CIS accounts or CIS arrangement. I think CS investments will still be governed by the laws of succession of Uganda. Okay, just like what you have in a bank account will still be governed by the succession laws of Uganda. So the same will apply here. I think on government imposing minimums, I didn't get the question well, but what I know is that we do have a liberalized economy, and in a liberalized economy, what the government does is that the government usually lets the private sector you know, to undertake different activities, with the government providing the necessary legal regulatory framework, and you know, the government being on the lookout to ensure that the interests of the investing public are protected. Okay, so that's how I'd like to look at you know, the scenario that, you know, in a liberalized environment, free markets economy, the role of the government will be to facilitate by, you know, protecting the public, ensuring that there's a level playing field, providing infrastructure, and letting the private sector do its thing.
All right, thank you, Dixon. To the person who asked, Henry Tumuine, your question on the government intervention, I hope it has been answered satisfactorily. If it hasn't, please rephrase so that we can tackle it properly, we can respond to it properly. So I do have a few other questions as well. I love how the audience is fully engaged. For sure, you will earn your breakfast or lunch or dinner for this session. So to Dixon, how is the unit trust different from other pooled investments like a mutual fund? That's something that has come through from Asasira. How is it different from a mutual fund?
It's the same. I think it will depend on the geographical location. So in the US, what we call collective investment schemes here are referred to as, you know, mutual funds. Okay, so it's just a matter of, you know, your geographical location. I think even in Ghana, they refer to what we call as CISs here. They refer to them as mutual funds. Okay, so I would like to just say that this is the same idea, but I guess it's more of nomenclature, a bit of nomenclature or semantics, or would I say semantics, but the whole idea is the same, you know.
Thank you, Dixon. John, I think this would be a fantastic question for you from Dan Mugisha. Do any of the panelists use multiple unit trusts or just one? Also, how would you use unit trusts to aid business cash flow and also personal cash flow? I believe you touched a bit on that, but I guess they do need a bit more content.
Thank you very much. I think I'm allowed to say the names of these funds. But I have unit trusts in several entities. And as a layman, I was imagining just to diversify my risk further, why not split up my 1 million into maybe 3 different funds? So, for instance, with UAP, I have a personal account with UAP. My business also has an account with UAP. I have a joint account with my wife. I have another account. Now, for UAP, it serves the needs of family, day-to-day school fees, and also the business liquidity. Now, I have also another account with Britam, and for Britam, it's really saving for vacation. I mean, we need to eat some of this money. So I have an account with Britam, that is for the annual vacations. I have an account with Zeno, and why I like Zeno is that even with it as 10,000 from my mobile money account to the fund, I usually have idle on mobile money, so I'm like, why don't I also experiment with Zeno? And also, so Zeno is really just to put in that money which comes in unexpected, and I need to put it, I need to hide it somewhere before I spend it. So I have multiple accounts, and there's nothing wrong with it because you have different goals, so you have to know which operator works for you, and that's why I do it that way. Thank you.
All right, thanks, John. Dixon, from the regulatory perspective, the questions are many. I hope you're ready. So Gerald Valley Twawulida, Gerald has asked, recently the fund managers started asking for TIN numbers as a requirement from CMA. Are there plans for government to start taxing the interest earned on these investments?
I wouldn't, give a concrete yes or no. But what I know is that, their engagements, at very high level, in as far as matters taxation is concerned. I might not have a concrete yes or no with respect to that particular question.
All right, thank you. James Oyenya had asked, is there tax at a time of withdrawal or at any point of saving currently? Unit trust. Dixon, this is to you.
Now, if you look at the Income Tax Act, the income earned by the investment vehicle is actually exempt from taxation or income tax. So again, to me, that's one of the advantages that comes with investing through collective investment schemes, the fact that the Income Tax Act exempts income earned by the vehicle from taxation. Are there plans? Like I said, I wouldn't want to give a concrete yes or no because I'm not privy to those discussions. I think until they're made either official or
Understood. Thank you. Thank you. So I have a few other questions. This is from Kenneth Luge. What is our fallback position in the event that the company offering the unit trusts fund goes insolvent? Dixon, I think you had touched on that.
Yes.
Kenneth may have missed it.
Okay. I think what I'd indicated earlier was that there are different parties within the ecosystem in as far as management of investment is concerned. So you have the custodian, you have the trustee, you have the operator, and the whole idea objective of having all these parties is to minimize risk and ensure that your investments are well protected Okay, now your funds or investments are actually held by a custodian. Okay, your funds or investment are held in custody by a custodian. Okay, now the legal ownership is under the trustees. Okay, but I mean, this being a trust arrangement, usually trustees hold assets for and on behalf of beneficiaries. Okay, so there's a beneficiary at the end of the day who is you, the contributor. Okay, so these guys, the trustees, are legally holding these assets for a beneficiary. Okay, so you still have ownership, you're the beneficial owner. Then should an operator manager go bust or become insolvent, this is very easy. I mean, there is clear segregation in as far as your investments or assets are concerned, and the assets and liabilities of the manager are concerned. Okay, so what happens is that should your manager go bust, since the manager does not own these assets, the manager does not hold these assets, what happens is that the next step will be to get another manager to manage your funds or to make decisions. Okay, in as far as your investments are concerned. So there's that clear segregation of roles, and your manager at no point will have control over your funds or hold your investments. Yeah.
Thanks, Dixon. So even if a fund manager, even if the company closes, the investments are safe. That's basically what investors should know. That even if the company closes tomorrow, their investments will be managed and transferred to another fund manager, because that those systems and the governance structures have been set up for all the licensed firms. All right, thank you for that. John, I have a question for you here, and this is from Bright Pitia. How long is the investment period? Expound more on that. And also, can I withdraw my money at any time of convenience? As an investor, John, perhaps you
yes.
could give a bit of light.
So the investment period really depends on your objective. For instance, you want to roof your house in 2 years, or you're getting married in 2 years, and then you start saving towards that goal. But that does not stop you from withdrawing your funds at any point in time. And you can literally withdraw all your funds. You can deposit any time. So I think that's the flexibility with the unit trust. So you can hold them for as long as you can. And it's advisable that you hold them for probably 3-5 years, depending on your objectives. And the longer you hold them, you benefit from something called compounding. If you know this genius called Einstein, he says that compounding effect is the eighth wonder of the world, and those who understand it earn from it, and those who don't pay it. So there's something magical about compounding. That 100,000, if you're doing it consistently for 10 years, 20 years, 30 years, will generate hundreds of millions in returns, because the interest earns interest on itself. So it compounds. And the best thing you can do with compounding interest is not to interrupt it. And interrupting it is withdrawing funds. So you be consistent in your deposits, a regular schedule. If possible, you increase. For instance, if you get promoted at work, then you increase the deposit. And with compounding, you can actually have a big nest egg. Thank you.
Thank you, John. Dixon, I've got 2 questions for you. One is from Andrew Kambugo. With respect to the fees that fund managers charge investors, how does the regulator protect the investors' interest, for example, against exorbitant fees?
Again, being in a liberalized environment, I think it might be counterproductive for you to start placing caps on the fees charged by managers, because these fees reflect quite a lot. I mean, the costs, the operating margins, they put in, or they price in their profits, you name it. Okay, so it's a function that the management fees are a function of so many variables. Okay, which might vary from manager to manager. Okay, so it might be counterproductive for the regulator to actually dictate what the minimum or maximum might be. But what I mean is that as the sector expands or grows in size, as the assets under management increase, then tendencies to have costs coming down because you're now dealing with a much larger scale. Okay, so as the sector grows, as the assets under management expand, we're likely to see a drop in the fees that managers charge. Now, the other thing, the advice I would give is in the absence of regulatory controls, then I think the wise thing would be to make a comparison between the different managers. Okay, vote with your feet. Okay, look around, look at the fees charged by the different managers, and go for the manager who you believe will give you the best value at the lowest cost. Okay, so I think that would be the best approach. Do a comparison, identify the least cost fund manager, creating the most value, and go with that particular option. But in terms of regulating fees, I think that could be a minefield. That could be a minefield. I mean, it's very easy for a regulator to, come up with those numbers, but it could be a minefield. But I think as clients, you just vote with your fees. Go to the least cost manager in as far as management fees are concerned. And again, like I said earlier, as and when or as the assets under management increase, or as more Ugandans save through unit trusts, then we will be having a larger scale and costs will definitely come down.
Great, thank you, Dixon. This is from an anonymous attendee. How often does the CMA publish reports showing the comparative performance of fund managers, and where can we access them?
We do that every quarter, and for the quarter ending March 2022, the quarterly report should be coming out in the course of this week. So this particular report has quite a bit of details on, where the CS manager is investing, how many Ugandans are investing, assets under management, asset allocation, performance, you name it. So you should be on the lookout for a quarterly for the period ending March 2022. And I mean, if you go to the website, we also have quarterlies from we have historical quarterlies as well, so that can help you give you a historical kind of picture. Yeah.
Thank you. So that would be on the CMA website, cmauganda.co.ug. All right, fantastic. Thank you. So John, I've got a few questions from investors here. One, I would like to know, this is from Edrin Moshave. Hello, I would like to know if there's a season for investing in the unit trust or any time is okay. That's one. And the other question is, can an investor withdraw his or her invested amount with or without penalty? And for John, since you seem to have experience with most of the fund managers, please share your experiences with others.
What I've experienced is that there is really no season. You can invest. I would actually recommend that immediately after you get off this call, you contact Jackie from NSSF to give you the contacts of all these fund managers. That's how you move from idea to action. The people I've talked to about unit trust for 3 years, they're still asking interest, risk. At some point you need to act. So there's no season for investing. 100K is little money to risk, at least to learn and to get into the scheme of things. Can you withdraw any time? You can withdraw any time. Typically, they prefer working days. If you send in your request on weekends or public holidays, it will only be processed when it's a proper working day between 8 and 5. So if you send your request after 5, it's a bit hard for them to process. But you can withdraw any amount anytime. Thank you.
Yeah, just to add on, I think when it comes to investing, um, I would really, really insist and emphasize it shouldn't be a matter of seasons or seasonality. I think investing should always be driven by your goals. That should be the starting point. What do you want to achieve? Um, is it a holiday? Is it roofing? Is it your conjuler? That should be the main driver, your goal. Okay? And once your goal is clear, then the investment, it's easier to come up with an investment option that matches up with your specific goal. So your goal should be the foundation. It should be the driver of everything. Okay? What is your goal? And once your goal is clear, then which investment option will be able to meet or satisfy your goal? I think that should be the driver.
All right, thank you so much. Speaking of goals, I see a question here from Sylvia Nankeve. Can I open a unit trust for a minor? And I would like John to respond to that, seeing as you've been able to operate separate, different unit trusts.
What I've experienced that you can open up in trust of a minor. So as a parent, the account is in my child's name, but I'm holding the funds in trust of the minor. And I think Dixon can speak to more of the legalities around it.
You're absolutely right, John. I think you can open an account for minor, but it has to be held in trust by the parent, so it's acceptable.
All right, I see we still have a couple of questions coming through, and it's only fair that we discuss the risks that are associated with unit trusts. And the first question here is from Robert Kato. When I invest my money in a unit trust, at the time of withdrawing, am I assured that what I will get will not be less than what I invested? Or is there a possibility that it can even be less depending on market conditions? I would like to hand that to you, Dixon.
Now, to address that particular question, what you get back will be dependent on the type of fund that you've invested in. Okay, and I'll give an example. If I've invested in, say, a fixed income fund, which is investing or whose underlying is basically debt securities or fixed income securities. Okay, so I know that these are, say, bonds, these are treasury bills, and there's an interest earned on this particular principle that I've provided. Okay, so what I need is that at no single point will my return be less than my principal amount. Okay, because the underlying investment is simply debt securities, fixed income securities, which have a principal amount, and the principal amount accrues interest over time. So at no point will my investment be less than, or what I redeem be less than what I invested initially. But for other type of funds, and I'll give an example of an equity fund, which is a fund that can invest in shares of listed companies. If I invest at point A, when, say, the underlying shares are valued at 200 shillings, okay, and I exit at point B when the markets have had it rough, there's a lot of volatility, prices are going up and down, or macroeconomic conditions are not very favorable, high inflation, a slowing economy, high interest rates, etc. Yeah? You might find that if I've invested in a fund that invests in shares, the value of those shares has been affected by the prevailing volatility, prevailing negative macroeconomic environment. Okay, so you might find that at the point of exit, at point B when you're exiting, you actually get back less than what you have invested. Okay, so that can happen, but again, CIS managers have different strategies. And like I said, if I invest in a fund that invests in debt instruments or debt securities, at no point will what I invest be less than what I get back. But should I invest in, say, an equity fund, then there's that possibility. Okay, there's that possibility. However, One of the things that I also keep on emphasizing, and I think John also alluded to it, when you're coming into the financial markets, it's very important for you to have a long-term perspective to investing. Okay, you can time the market and get lucky. Okay, you can be lucky, but once you have a very long-term investment horizon, okay, that means that you can actually ride out all the volatility. Okay, you're able to ride out a lot of volatility. Okay, but if you decide to time the market, you could actually time it and exit at the wrong time. Okay, so just have a long-term perspective. Just have a long-term investment horizon. Okay, and I think you'll be able to better ride all the volatility, all the noise, all the macroeconomic instabilities or fluctuations here and there. So just have a long-term investment horizon, and you'll be okay. And if you're not going to have a long-term horizon, okay, then just do a fund that is invested in debt or fixed income securities. Okay, because that essentially means that your principal will earn an interest. It accrues interest from day one. Okay, and what you get back will always be more than what you put in. Okay, so if you're not going to be long term, then just do or invest in a debt security, a fund that has debt instruments as the underlying.
All right, thank you, Dixon. As you spoke about volatility and just the returns that people may expect, there's a question that came through from Amani Albert, and he says I missed out on the interest rate for the unit price. I need some clarification on this.
I think that question is directed at both of us. Well, I can share my own experience as an investor.
Yes.
And based on my own experience, I invest personally. I mean, whenever I get any windfall, I pack a bit of it in unit trusts. I invest through an investment club. Okay, and I can share my own experience. Okay, though that should not be taken as the minimum returns, but this is a personal experience. Okay, and again, the returns might vary from one manager to the other. Returns will vary from one fund to the other. Okay, now my own personal experience, I've invested through a money market fund. I also have an umbrella fund. Okay, now on my umbrella fund, I've been getting about 0.9% per month. Okay, on the money market fund, the returns would vary actually per month. There are times when I get 1%, there are times when I get 0.85%. But that's my own personal experience. Okay, so I shouldn't be quoted. The regulator said. I think that's my own personal experience, and probably John could also share his own.
Yes, yeah, you're right. Different funds have different interest rates, typically anywhere between 9 to 12, 13%, and it keeps fluctuating depending on the fund, the management fees, the economic environment.
John, is that per annum?
That's per annum.
It's
not per month.
Okay.
Yeah, it's per annum. Thank you.
Can I clarify also? The 1% or 0.9 is per month on a monthly basis. So that means that is what I get back at the end of every month. Okay, and it might vary. I might get 1% this month, and in the next month I may get 0.9, 0.85%. Yeah, so that's per month.
All right, thank you. So we have a question here from Julius Kagamba. John, I'd like you to take this. The money accruing from the investment in a unit trust, does it get automatically plowed back, or do they remit it to the investor's account?
The money is automatically reinvested, unless for some schemes you can opt to be paid the interest, but it's automatically reinvested, and you can see from your monthly statements that the principal keeps increasing. And for some funds, they actually show you a statement of the daily amount, the beginning of the day, and the interest you've earned.
Yeah, maybe just to add on to John's submission. John also talked about compounding, the power of compounding, and there's a lot of power in compounding where what you earn is reinvested, and what is reinvested also earns a return, which is also reinvested in addition to what you had initially put in. So there's a lot of power in compounding. Now, from a personal experience, I've had funds where I've had two arrangements. In one of the funds, whatever is earned is continuously reinvested over and over. Okay, but in another fund, whatever would earn would be sent. The interest I would earn in a month would be sent to my account. Okay, so it became part of my income, and I could plan based on that. Okay, so I had that arrangement with one of the fund managers and one of the CS managers, and at the end of every 30 days, whatever interest would be earned on my units would be sent directly to my account. So it became part of my monthly salary. I could plan on that and know that the next 30 days I'm expecting this amount, 1%, 0.9 to 1%, and plan based on that.
All right, thanks, Dixon. So that basically shows you the flexibility with which you can plan with your fund manager. Again, investing is very personal and based on the goals and what you want to achieve. So if you want to get your interest monthly, that's available. If you want it to be reinvested, that's also available. So I've got two last questions. Oh, not two anymore. All right, so the first is interest compounded monthly? That's the first one. The second one is, could you advise on the key points to look out for while choosing a fund manager? And I'll pass this to both of you gentlemen to pitch in.
Maybe I could go first. The interest is actually compounded daily. Okay. And I think John talked about managers who actually show you how much you've been able to earn, okay, on a daily basis. Okay, so there is continuous compounding. Okay, this interest is earned on a daily basis. Now, what should I look out for? I think as a regulator, I wouldn't say so much, but what I can say is that one, your manager has to be licensed, of course. I think that's a starting point. You shouldn't deal with someone who's unlicensed. So you should start by ensuring that you're only dealing with someone who's licensed. Then I guess the rest boils down to service quality. I mean, how responsive are they to communication? Returns are also important. I think I would prefer to deal with the manager giving the highest return in the market. And then, of course, the costs. I mean, who's the least cost fund manager or CIS manager? Okay, so those are things I would consider before investing. Track record. Do they have a track record? Who are the people behind these CS managers, this CS operator? I mean, are they qualified people? Are these financial experts? So the team, I mean, the track record and the team itself, these are things I would look out for to ensure that I get the right guy or the right manager.
Just to add on the service quality, of course, each player comes with a different value offering to the investor. Some will give you apps, some will give you online access to your statements, some pay within a day, some take 2 days. So I think for your needs, you need to do a bit of research and then experiment. I think that's the best way to learn, and talk to other people who belong to these funds.
Right, thank you, Dixon. Thank you, John. So our final two questions here are these unit trusts open to non-Ugandans too, and what would they need to do to invest in them? And is there a plan to have unit trusts in USD? If yes, how will the market interest rate be? And this is from Faith Nawaji. Dixon, over to you.
Okay, now there are actually no restrictions in as far as investing in unit trust is concerned for foreigners. I think we are a very liberalized economy, and I mean, if you look at, as an example, if you look at the equity markets in Uganda, 80% of activity is driven by offshore investors who are foreigners. So we have no restrictions in as far as foreign participation in our capital markets is concerned. So this is open to all. Now, regarding a USD product, as a regulator, I may not be in a very good position to comment on that. But I guess for any manager, before they look at doing a USD product, I think it will all be a matter of the business case. Does it make business sense? Are they likely to make some money out of it? Okay. What's the business case? What's the demand for this particular product? So there are all those considerations that a manager will look at before they decide to set up such a product. And how attractive is it to the clients? I mean, you could actually develop a product that is not attractive to the client. Is the client likely to make money? So there are all those considerations. And if the product is good, if the product is likely to earn some money for the clients, then why not launch such a product? Okay, it would. I mean, from the perspective of an operator, I would, if there is a strong business case, if there is demand for it, if clients are likely to make money out of it. Yeah.
Thank you, Dixon. John, would you be interested in a dollar unit trust?
Yes, for some of my dollar savings. Yeah, but I think for some clients it makes sense, especially if you're earning in USD, your business or your income is USD, then it makes sense to save in USD. Thank you.
All right, thank you so much. Thank you to the audience. We have really had some really engaging questions, and I am sure that the panelists have had a good time getting their brains picked. I would like to ask John and Dixon to give any parting words to the audience on unit trusts, and then I'll hand back over to Jackie to close the session. Thank you.
Thank you so much, and allow me to also thank the audience for bearing with some of us who can at times go off a little bit, but thank you for bearing with us. Just a general statement, or just a general parting shot. Just ensure that before you commit your money to any investment, just ensure that you're dealing with someone who's licensed. I think that would be my parting shot. Just ensure that at any single point before you commit your funds, ensure that you're dealing only with a licensed entity. Thank you.
Thank you. I think I appreciate the audience. Thanks for bearing with us. We are not the experts on these things, but we have a few points to share, and in the process we learn more. In a nutshell, I think financial freedom really comes from investing. Investing is about sacrificing something in the future for a potential return in the future. So, and one way you can transition from an employee to an investor is through a simple thing like a unit trust. So as you become more sophisticated, you'll start to understand the things Dixon was talking about. Talked of paper assets and but that's the journey. And as you learn more, you grow more, you compound, then you can secure that future for yourself, for your family, your clan, and your country. Thank you.
Thank you, John. Thank you, Dixon. Thank you, NSSF, for organizing the financial literacy program, which I think is the basis and forms the foundation for changing the way we all look at finances in Uganda. Thank you to everyone who put this together, and over to you, Jackie.
Thank you so much, the panel. Thank you, Gladys, for doing the best. It was actually very enlightening. We have learned a lot. I've actually learned, and I have my take-home as usual, which I'm going to share with the audience. So, take-home number one from the discussion: attach your investment to a goal. So if you're to buy any unit trust, please have a goal. Understand why you're buying that unit trust. Take-home number two: it can be your passive source of income. Take-home number three: liquidity, they are easily convertible into cash. So please look at that as we take our midterm benefits, or as we invest and save. Consider that they can easily be convertible into cash. Take home number 3, which I didn't note down, but I remember properly, was about income. So as midterm beneficiaries, when you get your midterm benefits, please consider it can be your income. You can use actually unit trust as your monthly income. You can save your initial income from NSSF and you earn from it monthly. It was my take home too, which we need to consider. Take home number, I've lost count, but we also talked about diversification. Please think about it. It can be your way of improving on your diversification as an investor. And then take home my last take home is that in case you need to understand these fund managers or to know them, please kindly visit the CMA website so that you get to know which fund managers are available in Uganda. And then my last take home is that do your research. Before you invest, do research, find out which investor is favorable for you, is you feel you're comfortable investing with. Yes. So thank you so much, the audience, for your participation. I believe financial literacy is going to impact most of us. Thank you, our followers, people who like what NSSF is doing in regards to financial literacy. Thank you so much, the different players in the market that are working with us to make it the best, to educate the members of this country. Thank you, NSSF, for the initiative. Thank you, our dear MD and management, and thank you, the NSSF Financial Literacy Unit, where we sit for this good job that we are doing. So I believe we should have answered most of the questions. I thank you so much, the panel, and have a very good day. Have a good day, our dear participants. Bye for today.